The idea of buying a house seemed dumb because the world was going global, home prices were barely moving, and the stock market was holding strong. Buying a house wasn't really as attractive as other investments. But 2020 changed everything. The Fed made buying a house one of the best investment decisions you can ever make. Prices literally rose by over 20%. The stock market definitely rose much higher, but it crashed. At the time of this script, the S&P 500 is up by around 12% since its pre-pandemic level, while house prices are up by around 20% since the beginning of the pandemic. However, that is slowly changing. We have talked already that this is not sustainable because unlike the stock market where everyone with a few dollars in their pockets can buy stocks, the housing market is different. A house is usually the biggest purchase in most people's life, so the market barely moves by 1 or 2% a year. That's why some economists warned us about another housing crash, since the last time house prices rose so much created the biggest financial crisis in the last few decades. So, since we're seeing more and more such headlines, our house prices are finally declining. Did the housing crash just begin? Will the current housing crash will be as bad as the crash of the 2008? We will answer all of these questions and many more. But before we do that, give this video a thumbs up and let's get started. On the 15th of June, the Federal Reserve threw an atomic bomb and surprised everyone with a 0.75% increase in rates. This is the biggest increase since 1994. That is going to have a devastating impact on the housing market since the last interest rate hike by the Fed already caused a serious damage to the housing market. It might be difficult to expect something to fall when it's rising so fast, but let's look at what's happening on the ground. According to experts at Realtor.com, more and more home sellers are slashing their prices in certain areas. This is actually serious since just over 6 or 8 months ago, we had cases such as this where buyers are ready to overpay for a house just to be the one who is going to buy that home. Seems like the days when buyers would bid for a house are over. We are entering a new period where sellers might have to enter into a price slashing war to attract buyers. At the end of May, Redfin reported that nearly 1 in 5 buyers were lowering their prices. Something not seen since October 2019. There is a simple explanation behind that. The vast majority of houses in the US are purchased through mortgages. To be more precise, over 60% of homes are financed. When the Fed raises rates, the cost of borrowing capital rises, lowering the number of debts borrowers can take with their current income. A smaller mortgage limits their options, resulting in a lower demand, pushing sellers to slash prices to sell, and so forth. Moody's, the credit rating agency, gave Fortune exclusive access to its updated analysis of the US housing market. They tried to find out whether people with local incomes could support local homes. Throughout the first quarter of 2022, national house prices are overvalued by almost 25%. That's up from the fourth quarter of the last year when Moody Analytics determined national house prices were overvalued by around 20%. When the gap is too wide between house prices and what people can afford, it's a matter of time before demand significantly drops. That's when you know that the market is overvalued. That's why experts at Atlas Research found out that more than 25% of homes on the market right now have cut their prices. Zillow found a similar trend in its data. 6.4% of homes listing on Zillow saw a price cut, the highest weekly share of price cuts in more than 5 years. At the end of the day, the laws of economics determine the market's direction. In January of this year, the supply of homes finally returned to its pre-pandemic level. However, mortgages were still attractive to drive buyers. However, fast forward to today and the market has changed drastically. The supply of homes in the market hasn't just risen slightly, but it's at the highest level in the last 12 years. Last time the supply of homes was at this rate back right after the 2008 crash in May 2010. Of course, there are many reasons behind that, but one of them is definitely the fact that sellers have realized that prices aren't going to keep rising if they keep holding on to their assets. They have reached their peak, and the downfall has already begun. If you don't sell now, tomorrow might be too late. The urge to sell before mortgages become too expensive is driving the supply of homes to the roof. That's actually a really dangerous sign of where the market is, because it illustrates that the shortage of homes in the market wasn't because we couldn't build more homes, but rather because buyers were not willing to sell, waiting for a better opportunity. The question is, what percentage of the houses in the market were purposefully held by the sellers? If that number is too high, we might find ourselves in a market filled with homes but very little demand, which easily can lead to a catastrophe that we have witnessed in 2008. The consequences of the 2008 crash lasted over a decade. The problem is that the US economy is not in a position to witness another such a crisis. The challenge that the country has been facing for the last 2 years are already shaking the economy. Mortgage rates have already hit 6.3%, and the real cost to buy a house has officially spiked over 50% in just 6 months. That marks the highest mortgage rate since 2008. The 3.2 percentage point jump in mortgage rates over the past year also marks the biggest upward swing since 1981. Soaring mortgage rates mean many would-be borrowers who must meet banks' required debt-to-income ratios have lost their mortgage eligibility, while buyers who are underrated will simply have to pay more, a lot more. It will take us another few months to realize how much the demand is going to fall over the next few months. And if the Fed hikes the rates again to over 2%, as some experts expect, things might get really ugly by the beginning of 2023. Of course, there are experts who are calming us down that a crash isn't gonna happen, and I really hope that's true. But experts also predicted that the average 30-year fixed mortgage rate would climb from 3.1% to 3.3% by the end of the year. We can't say for sure what to expect in the next 12 months, since there are so many factors that are influencing the Fed's policy. The US is trying to balance between managing its internal affairs at home and standing up to Russia's invasion of Ukraine that is causing worldwide inflation. Rising rates alone aren't going to change everything. If inflation keeps rising, home prices are unlikely to fall, since inflation will simply make the cost of building new homes more expensive, which will at least keep prices where they are. The Biden administration already announced that the president will visit Saudi Arabia to convince the crown prince to increase the supply of oil to fill the gap and finally bring prices down. Will he succeed? I don't really think so, since oil-producing countries are making more money than ever. But how negotiations are going to continue will remain to be seen. So the direction that the housing market is going to be headed isn't just based on the Fed's policy, but is also greatly affected by external factors. Thanks for watching, and see you in the next one.